Ask Chad Sorensen what wins in 2026, and he will not say growth. He will say execution, and he will say margins. This is the Distinguished podcast from the Boston University School of Hospitality Administration, recorded on the road at the NYU International Hospitality Investment Forum in New York City, with guest host Kaushik Vardarajan, director of our real estate program. Chad is the CEO of CHM Warnick, a leading hotel asset management and advisory firm, and vice chair of our real estate advisory council. He explains why the year ahead is won line by line on the P&L, how his team uses business intelligence and AI to find savings without touching the guest experience, what is behind the wave of owners changing brands and manager at the same time, and how he counsels owners on where to put their capital. Let's get started.
All right, so this is the Boston University School of Hospitality Administration's distinguished podcast on the road at the NYU IHIF conference. And I'm here with our next guest, Chad Sorensen, CEO of CHM Warnick. Chad, thank you for making the time to join us.
Great. Kaushik, thank you for having me.
So I hope you're having a great conference.
Absolutely. You as well. There's been a lot of enthusiasm on this first morning, which is great.
Yeah. What are you seeing generally in terms of sentiment?
I would say the sentiment is definitely more positive than we were thinking, way back in January in Alice. And I think that comes on the heels of a Q1 performance across the industry that was generally better than anticipated. So I think after a couple of years of real challenges, and most everyone looking into 2026 as a year where RevPAR growth was going to be muted, and actually seeing that it's at 3.5%, I think through Q1 is really encouraging. We've got a lot of year to go, but I think that helps with the way people are feeling around here today.
Yeah, I think that's great news for everyone across the industry. You previously stated that 2026, our success in 2026 isn't about growth, it's about execution, it's about margins. So can you talk to us about how you're going about it with your owners?
Yeah, should I start with how I was wrong? Because I think that's the case, right? As I mentioned, it's been a really good story so far. Our portfolio through Q1 actually saw a double-digit RevPAR increase. We do feel we'll lose some ground over the next 3 quarters, but should absolutely find ourselves with respectable RevPAR growth by the time we get to the end of the year. At least that's now the plan, I hope. That being said, with inflation being where it is at, that negates the real growth, unfortunately. But we are seeing growth. So I think what we are seeing is on the expense side, that has not taken our focus off, right? Having good top line, especially on the room side, has not taken away from the importance of really focusing on the details of the operation. And we've been talking about labor wage rates, et cetera, for the last few years. I'll say I believe it's stabilized, I would call it, last year. And as we work through 2026, it's been predictable is the word I would use for that. It's labor is still costing us more than we'd like to pay, but it does seem more predictable in this environment. So we spend a lot of time on other areas in the business, right? Hotels are a really complicated business, but the positives of that is that means there's a lot more levers you can pull and buttons you can push. So while labor is the biggest expense, we're spending a lot of time on items below the line, whether that's helping clients refinance their projects. We're definitely seeing more opportunity there. Insurance costs have stabilized to a degree in many markets, which has been good to see. There's always work to do when it comes to taxes. And then on the operating side as well, I think AI is starting to introduce some really interesting solutions. I can't say that we're seeing a lot of impact at GOP yet, but I think we will see that. We continue to take the P&Ls apart line by line and really leaning into business intelligence, which we've been in that game now for over 10 years. And as we've layered AI in over the last probably 24 months, we are finding ways to cut expenses in ways that we really didn't discover before, which is exciting. It really is exciting to see how data and technology can help drive performance.
Yeah, that's great. So I think one of the challenges or concerns at least is that in an attempt to protect margins, that will often it seems like some people are going the other extreme and compromising on the guest experience, compromising on the basic service model. How do you stop yourself from doing that, and how do you find that balance?
Listen, if you're not taking care of the customer and you don't have a focused plan as an operator on that, it's going to be a really challenging year and beyond. I don't think most of us didn't see what was coming out of COVID, where our guest satisfaction scores had really plummeted. And it didn't matter the brand, it didn't matter the location, it didn't matter the segment. It was a big unintended kind of situation that we all found ourselves in. And so the good operators in the asset management firms like ourselves, we are absolutely dialed into the guest experience, and cutting your way to the bottom and trying to find ways to offset expenses if it's going to impact guest satisfaction, I think is a very short game, and not the way to look at this. We've got to stay focused, and really it's kind of seen through all lenses. The brands as well, right? The brands, generally speaking, have been working with owners to deal with what is probably the biggest issue out there, which is CapEx and PIP and maintaining buildings to brand standards. And the core metrics on that is guest satisfaction. If the guest is telling the brand and the owner that they're not happy with the experience, or they're not happy with the quality of the product, the brands just aren't going to sit on the sideline and not push the owners and the management companies. And so it's definitely a push and a pull as we try to recover some of the GOP that we lost coming out of COVID. But it's a short game if you're trying to do that through expenses. You need to double down and continue to find other ways to cut expenses, but staying laser focused on guest satisfaction is really key to being successful long term, I think.
Okay, I'm glad to hear that. So Hama last year in the fall, conducted their survey, which I thoroughly enjoy reading, and the survey shared that roughly about 25% of asset managers are seeking both brand and management changes at the same time in their assets, right? That seems quite aggressive, that you're making dual changes at the same time and that 25% of them are doing that. Why do you think that's happening now?
That's an easy question with a really complicated answer, because there are a number of factors, I believe, that go into that. Kind of when we talk with our clients on their acquisition strategy or just optimizing their investments, almost everybody is, if you own the asset, you've had to rewrite your investment thesis. And when you rewrite that, you have to step back and take a look at what does the operating business require moving forward. And a lot of times, going through that exercise will identify that maybe the property isn't branded correctly, or may not be the right type of management company. There was just so much change in the world of management companies post-COVID. The large brands, the Marriotts, the Hiltons, the Hyatts, as we all know, they've expanded the number of brands that they have, but they've also generally taking a step back from the type of assets that they need to manage, right? So they're still in the management business, but it's the key assets more than ever. And so what that's done is created this kind of what I call a frothiness in the market for third-party management companies. And the third-party management companies, they were hit hard during COVID, so they've had to rebuild their companies as well. And so I think there's just been all of these different dynamics that have changed The brand's getting out of management, means there's more need for third-party managers. The third-party managers, again, they didn't see coming, like we haven't, generally speaking, the shortage that we were going to have on the staffing front, and that's both at the line level and the management level. And so I think you're finding owners that don't have strong, advisors, i.e. the asset management. They many times are ending up with the wrong brand or the wrong management company for the new investment thesis. And so that has led to, and I think will continue to lead to, just churn in the space. Having the right brand, the right manager can absolutely be the difference of an investment being a success or not. And it's very expensive to pick the wrong operator. And then have to change them out, say in a year or 2 or 3 years. You've not only lost that period of time, it's the disruption that comes along with making a change. So, majority of owners don't take, rebranding or, changing up the management company structure lightly, because it's really disruptive. And at the end of the day, that costs a lot of money as well. So I think we'll continue to see that, though. I mean, the transaction market, obviously is heating up a little bit more, but they're going to continue over the next several years to be a lot of deals where the investment thesis as underwriting it for an acquisition just looks different from a need perspective, which is going to drive change. Brand management. You have to look at all those different scenarios.
Okay. Yeah. And Chad, in addition to kind of being an asset manager for specific assets, you're also a trusted advisor to a lot of these owners, and and oftentimes they come to you asking you for your thoughts on capital deployment. If they have capital, what are you telling them? How are you addressing kind of the buy, hold, sell kind of analysis or discussion, and what are you recommending owners do if they have capital today?
Well, it all begins with what's the objectives, right? I mean, that's one of the really interesting and kind of competitive advantages of running a third-party asset management advisory firm is we have a very diverse group of clients that all have different needs. At the same time, we have a lot of diverse assets and management companies and brands where we've got this really wide lens. And so it starts with a conversation around, what is your investment thesis? What is your hold period? And what are you trying to accomplish? What are your goals? And surprisingly enough, you've got a lot of individuals or groups that are maybe new to this space where they can't clearly articulate that. And so a lot of times we start at the kind of starting line with them, take them through that process and understand not only what they're looking for, but why are you looking for it? What's the end objective? And then we are with them as their advisor and their expert throughout the process, whether it's helping identify key acquisition targets. I would say there's as many deals getting done outside the brokered world than there is in the brokered world, and we're seeing a lot of assets come around a second, third time in the brokered world. So, part of it is being patient because there's so much capital out there, but being dialed in on what your strategy is and have a platform in place to evaluate those deals that maybe fit your parameters. So we spend a lot of time on the analytics around the why. Instead of just help us find an asset to buy. And we find ourselves as educators, honestly. It's just, because we, like I say, we can touch a project all the way from cradle to grave, right? Somebody may come to us with an idea, a piece of land, a bag of money, and we can take them from that and help them execute on their vision. And there's just a lot of decision-making points along that path.
Okay. So now, Chad, my last question for you. So if you woke up tomorrow morning and you had $100 million in your bank and you had to invest that in the hospitality space, what kind of assets would you buy? What markets would you go buy in?
Boy, that's a tough question. It goes back to my answer on the last one, right? What's the strategy? What's the investment thesis?
So what's yours?
What is mine?
This is your own personal $100 million.
It's while not sexy in that solid select service space, is always less risky, I would say. But I think from an acquisition standpoint, or let me back up. So, like I said, on the full service space, it has to be an acquisition because development's just too expensive anymore. So, I would say it's either solid secondary markets where I know there's things that we can do from the level of sophistication that our platform has that we can easily kind of outsmart the market. And I still think there's opportunity in the distress space, but it's not gonna show up on your front door. You've got to figure out what's behind the scenes to be able to get into those types of deals, which I think we're pretty good at, and we've had good success post COVID. So I'd probably take that money and again kind of leverage my team's exposure and experience and partners in the marketplace. I do believe that all the primary markets are going to come back. It's just a matter of time. I mean, you've still got the Portlands and the Seattles and the Minneapolis, but in some of those markets, there's great acquisition opportunities when you're kind of buying by the pound versus by the cap rate. So I guess go back. It comes down to the strategy, right? And I've got the money. What is what are you trying to accomplish? I think there's multiple paths you could go down.
Okay. Well, that's all we have time for. Chad, thank you very much. So this was Chad Sorensen, CEO at CHM Warnick.
Great.
And Vice Chair of our Real Estate Advisory Council. So, Chad, thank you for joining us.
You're welcome. Thank you, Kaushik.
That brings this episode to a close. Thanks for joining us on the road at the NYU International Hospitality Investment Forum, and our thanks to our guests for sharing their time and insight. The Distinguished podcast is produced by the Boston University School of Hospitality Administration. If you enjoyed this conversation, follow or subscribe wherever you listen and share it with a colleague or a student who would find it valuable. To learn more about our programs and the work coming out of the school, visit bu.edu/hospitality. We will see you next time.